Sorry about that. Insurance companies were very tepid about moving forward with their underwriting because of the unknowns of COVID. But they now, Lincoln has taken the aggressive approach of saying, we're open for business. We want your business. We're reinstituting table shave. And we came out with some great product to add to our portfolio in light of Section 7702. They are one of the first companies to revamp their product, and they're going to go into it. And what the 7702, it allows the insurance company, allows the clients to put in more premium into their policy without it mecking, which makes premium finance a more attractive venue, being that you want a highly cash-rich product. So without taking any more of anyone's time, I want to give Michelle Sollosi and Michael Palatiello all the time that they need to really go through their product portfolio and why it's such a great thing. So take it away.
Neil. Thank you. I appreciate everyone joining us today and taking time out to attend this Zoom meeting. As Neil had said, we work closely together, and not only does it take a good product in order to have the relationship, it also takes good underwriting, understanding of one's business, and developing ideas and sharing that ideas that are relevant to the marketplace today. So Neil and I speak on a regular basis what he sees in the market and what I'm seeing in the market, and as well as Michelle, and we share these ideas because if there's activity that's happening, we like to tell Neil so he could share it with you all on the line. So that kind of was the catalyst of today's call. What's happening is specifically in the premium finance market. The premium finance market is continues to be a very hot and important market for Lincoln, as well as with the entire industry. And there are a few drivers there. The obvious driver has been low interest rate environment, and low interest rate environment makes premium finance attractive to those clients that have working capital that they rather continue to work either in their business, their investments, real estate, and so on, rather than committing the cash to an insurance policy. So with low interest rates and banks willing to loan for this particular purchase, your clients can go out and borrow money at extremely low rates and continue to use their own money to invest the way they have. Now, with that said, that's been the major driver for the last several years. What's made this year even hotter has been the discussions within the new administration on changes in the estate tax and in income tax in general. And those proposed changes will drive the estate planning market. And there is a drive to take action, and that action needs to be taken prior to 12/31. And a lot of that action will require the purchase of life insurance held in an irrevocable trust, where they could take advantage of the gifting that is available in a lifetime exclusion that's available in 2021, that under the proposed tax changes would disappear in 2022. So there is a timetable here to take action that you all should be sharing with every client that might have tax exposure, which would help you to drive a life insurance sale. Now, whether it's premium finance or not, that's for you and Neil to work out. But premium finance becomes very important. Some of the markets that we see premium finance working in are those who are rich in real estate. They're illiquid, and they have significant net worths, but it's not liquid enough for paying a high premium. They don't want to sell any of the real estate that they have. in order to pay for these premiums, at least currently. So premium financing can work very attractively for individuals who are identified as high net worth real estate owners. Automobile dealers are another market that we see a lot in, and those individuals have, they're actually very good because they are understand leverage and understand the need for estate planning. They have significant high net worths, and most of the cars that are on that lot, there are loans against, so they need to be able to provide for the liquidation of that debt in the event of death, or the estate tax that might be assumed there. Construction companies are another target market. Again, very capital intensive. They need to maintain cash on books in order to keep their bonding premiums low. So that cash is tied up. So premium finance works well as a alternative funding for their insurance. Hedge fund managers. Today, the market is hot. Hedge funds are making a lot of money. The managers are participate in their funds, and they could have access to capital at a really low rate. So they are also a target market. So and then any capital intensive manufacturing business that you might see, these are all potential clients, potential people that you would talk to about premium financing. Doesn't have to ultimately end in a premium financing sale, but it starts the conversation and shows them how they can purchase life insurance through borrowing from the bank and having an exit plan from the insurance policy. And we can demonstrate that with our product. So these are examples of markets that we have seen a lot of activity in, and it has been driven again by low interest rates and the changes in the proposed tax treatment for estate planning as well as for income taxes. These markets are also important because what I just described are all markets that are used to working with banks. They're used to borrowing money from a bank. They understand how loans work. They understand the risks involved with borrowing money and changing interest rates. So they do it every day. So this presentation would not be foreign for them. It's really focusing on what the need is for the net death benefit for their estate, and how would you like to go about purchasing it. And premium financing is very attractive, and Michelle could tell you the number of illustrations she runs on a regular basis of what's going on. Now, with that said, what's changed this year in the industry? Well, Neil had mentioned that 7702 took place. 7702 took place on January 1, and it requires all insurance companies to comply with it by December 31 of this year. Many companies have already adjusted for 7702, including Lincoln. And when Lincoln revamped their product to accommodate 7702, it really became incredibly attractive and highly competitive in the premium finance market. We've pretty much in every example we've run, we're the leader today in the market. With our product change for 7702, the companies that have already changed for 7702, and obviously the ones who have not are lagging behind in general. We're also finding that the companies that have term riders built into their contract in order to enhance the performance, that our contract without a term rider is handsomely beating these with a competitive design. So putting all those things together, Lincoln is in a very good position for the changes and for the opportunity in premium finance. Now, 7702, as Neil said, changed the MEC requirements. So it allows for an insured or an owner to put more money into a policy than they were before without creating a MEC. Now, in the premium finance market, this is important because it allows more money to go in. It allows the policy to perform, to get higher cash values earlier, which then allow us to roll out of the policy to repay that loan earlier than we had been able to do in the past. And that is attractive because the client, although they're borrowing the money, there is a compounding interest payment that needs to be made to service the debt on the loan for the policy. Now, we do allow for some creative designs as long as a client has specific net worth. I'll let Michelle talk about that a little bit more. So we can be flexible there. But they basically have to service that debt every year. And the advantage of premium financing is if we look at the servicing of the debt as their outlay, and we compare it to the death benefit delivered at life expectancy or beyond, that rate of return on an after-tax basis is impossible to beat on a guaranteed basis from an alternative investment. So the fact that it's income tax free, the fact that it can be designed to be estate tax free, and you can deliver a rate of return that is in the 8 and 9 or 10% at life expectancy after tax, that is significant. So we compare the servicing the debt to the death benefit delivered to get that IRR. We compare as compared to somebody just paying an insurance premium, and that insurance premium would be lower than a premium finance loan because you're not trying to build up the cash as quickly to roll out to pay the premium back. But the amount that they're paying, first of all, is going to be more than the debt that they would service on the loan. And secondly, it's not going to deliver the same IRR as you would with the leverage of a premium finance. So that's what makes it attractive to the market that I described. The people who understand the leverage, who have been borrowing money their entire business careers to fund the type of businesses that they have, whether it be manufacturing, real estate, hedge funds, construction companies. They're borrowing for all those other purposes. This is just another purpose for them to borrow. The market has a number of lenders that specialize in premium finance. Lincoln doesn't care where they're borrowing the money from, as long as the loan is fair and the fees are reasonable to the client. So we do underwrite the policy for medical and risk needs, but we also look at the premium finance terms to make sure it's fair to the client. And if it is fair, then we'll allow it to move forward. If we feel that it's the loan is too expensive for what they're getting, then we were not going to allow that client to participate with a Lincoln contract. So there's underwriting that needs to be involved on a medical basis as well as a financial basis for the loan. In addition, they need to go through the financial underwriting with the bank that they're using. You could use a premium finance bank, and there are some that specialize in this market in particular. Or they can go to their own bank. And in many cases, there are business relationships that are long-standing with banks where the client can borrow money for less than what they would be able to get from a premium finance bank. That's totally up to you and the client. But most of the premium finance lenders are very low rates and very reasonable today. But I have seen, and Michelle has seen, a number of bank relationships that clients had that are really these ridiculously low rates. We had a case recently where, don't ask us where they got it, but it was a 2% fixed loan for 10 years. It's an incredibly low rate, lowest I've seen for that long period of time. So those combinations are things that Neil works with us on. You know, we're going to ask Neil to work with you to gather a lot of information in that sale. If you're not familiar with the premium finance market, if you are, you know what you're getting into. If you're not, then Neil can walk you through and make you comfortable with it. But if you have a high net worth client who's involved in illiquid activities, then you should be showing premium finance. Doesn't mean you're going to go in that direction, but you should introduce it because somebody else is going to introduce it to that client. I will say from a Lincoln perspective, we want to see a high enough net worth where the client understands the risk that they're being involved with. And then, you know, there's a risk of performance of the policy. There's a risk of the interest rate, both today and in the future. There's a risk of requalifying for the loan. So some banks are going to make you requalify every 3 or 5 years, just to be sure just to be sure that you're still qualified for the future premiums that you're committed to. Other ones will lock you in for whatever the period of time is. So there's a question, Scott.
Yes, Mike. You said that you like high net worth individuals. So is there a bottom floor of what that high net can be, or can it be also somebody that got huge amount of money in trust that someday is going to have all that money?
As long as it's an irrevocable trust, where there's no question that they're going to get it, we'll consider that from a net worth perspective. If it's a revocable trust that they're the beneficiary, we have a hard time with that because that can be changed at any point in time. So if it's irrevocable,
parents, they're irrevocable.
If it's irrevocable and
parents getting them out of their estate, so they're irrevocable.
Yeah, if it's irrevocable, we'll consider that.
Okay, and what would the number need to be now?
I think 5 million or above is the minimum net worth. We will go a little lower for younger ages, but they got to make that up with the income so they can service the debt. But I think if you really want to be in this premium finance market, you should focus on $5 million above. 10 million or above is even better.
Okay.
Right. That's what we see. And I know there are others out there who are showing it to significantly less net worth, but I don't know if those people understand the risks.
Yeah.
Before I go any further and turn this over to Michelle to show you some pieces we put together, are there any other questions?
You know, Mike, I'm just going to add a couple of things to what you said, just to add fuel to the fire. I've been in this market a long time, and we do quite a few cases in this arena. And a couple of you could call them sales points or understandings that you need to have. One is, a lot of people get hung up on what's my loan rate versus what my performance is. That's the first thing a client's going to ask you. Well, what the loan rate is and the performance is really, you got to ask your client, what's the cost of money? If you're a real estate investor and you're making 10 or 20%, or any entrepreneur, and you're making 10 or 20% of your money, you go, what's your money worth to you? Well, it's worth 20%. Well, wouldn't you rather use someone else's money instead of your 20% money? And that's a real interest rate switch that you have to make with clients, number one. Number two, the money borrowed in a premium finance policy, if done correctly through a trust, does not affect someone's personal credit. It's a very key point if you structure these things properly. If the money is borrowed against a trust, you don't want to tie up somebody's credit line for doing business. So that's something that we can discuss on an individual basis. Very key point. The third thing, part of the estate tax and the tax changes that the government is looking to do right now, of course, the government is looking to do infrastructure bills, plus we laid out all this money for COVID. So naturally they need to create taxes somehow. So estate tax is high on the priority list. Current exemption per person is 11.5 million, I think it is today. It does sunset in 2025 if the government gets nothing done. So then it goes back down to 5 million per person. But one of the other little proposals in there, and you know, Bernie Sanders has a proposal in for 3.5 million. I think Biden was leaning towards 5 million. You know, if they make that change, it's going to be made this year. The other thing they're going to do, and if they don't make the change, we're still going to go down while people are still making more money. So we think third quarter this year is going to be significant in this space. So, I mean, really thinking about it, people start making moves when they see changes happening. The other thing that's not talked about a lot is the decoupling of the gifting from the estate tax limit. It's a very key point. So right now, I think it's at 15,000 per person per year, or they match that 11.5 million per person as a one-time exclusion. They're talking about making $1 million total gifting that you can do. And that's significantly different than 11.5 million if they decouple those two things. And on that, when you're doing premium financing, you limit your gifting to the client because all your gifting is interest into a trust. That's the money that you're gifting. The borrowed money that you're putting in these premium finance policies is borrowed money. It's not your money. Since it's borrowed money, it's not considered a gift to the IRS. Now, any money you contribute from interest into your trust is. So you can significantly expand your gifting by doing a premium finance policy. These are all things that say why, if I have somebody negotiating for 10 million, a 20 million, a 30 million, a $50 million contract, why do I want to look at this route? It's not just a tremendous leverage play. It's a tremendous financial tax play, both on current income taxes and, of course, on death. And, of course, if the death benefit's inside an irrevocable life insurance trust, which we can help you put together, that's estate tax-free. So the money is completely out of your estate and goes to the heirs or to the charity or to who you want it to intend to go to, as opposed to allowing the government to choose where it goes to. I just wanted to make those couple of points. And again, if you have questions and you want to post them in the chat box, I'd appreciate it. Peter did have a question. Assuming a healthy client, a great credit profile, what is the anticipated time from start to finish to place a case? Is collateral required, or can the cash value serve as collateral until the loan is paid off? We're going to get into some of the intricacies, Peter, or Michelle will, on some of the riders they have regarding collateral, number one. And of course, you have a typical underwriting time for any insurance case. We like to get cases in and out, you know, in 30 to 60 days, if we can. And then making the banking arrangement can take some additional time. So when you're doing these type of cases, you want to kind of put most of this stuff together up front as much as you can. And I'm certainly glad to work with you. And then things can go very quickly. So you have two mechanisms at play: coordinating with the bank, coordinating with the program, and of course, regular typical underwriting. Peter, does that answer your question? Yes, no, okay, good. Michelle, go ahead. I know you want to go through it. Michelle is the premium finance expert at Lincoln.
Thanks, Neil.
Thank you.
Thanks, everybody, for joining us today. I kind of want to tie together what both Neil and Mike have mentioned. You know, in the industry, the biggest change we've seen this year is the 7702 updated rate assumptions. And all but, I think, with the exception of two of the major carriers in the finance space, have updated. I don't know if any of you were able to attend our one meeting last week, but we did share a couple of numbers showing where Lincoln lands now that we have updated for 7702 against those other carriers that have updated. I think it's also important to mention, while these updates are occurring, it doesn't necessarily change the client profile that we're looking for. The client profile doesn't change. You know, these people typically have estate planning or wealth transfer needs, or looking to supplement some retirement income. But what it does change is our illustrative ability, and as Neil had mentioned and Mike, we're able to now get more funding into a life insurance contract. So what that's really done for Lincoln is given us more opportunity in that estate planning wealth transfer space. And as you can see on the screen, hopefully, compared to the other carriers, again, there's only one on this list that has not updated for 7702, but Lincoln here is at the top of the chart. The first assumption is utilizing our default crediting rate of 5.7% and our Fidelity AIM fixed bonus account. All illustrations are ran the same, assuming their optimal index account, paying for 10 years, 55-year-old needing 10 million in death benefit. And as Neil has alluded to the estate tax change on the horizon, we know that these estate planning cases are dependent on that death benefit at life expectancy. And as you can see here, at a roughly life expectancy year 30, Lincoln is significantly above that needed 10 million. Our target is also, if anyone notices, is significantly higher than the other carriers. And then at the bottom of the chart, we ran these numbers at a reduced crediting rate of 5%. And Lincoln is still at the top of the chart there, maintaining above that 10 million, where only one other carrier is at that 10 million at life expectancy. All others are falling short. So, this is exciting for me in this space because it gives us more opportunity for these wealth transfer goals at an optimal time. So, I think that Peter maybe had mentioned, or somebody else had mentioned, the collateral needs. So of course, when you're looking at now additional funding into a contract, you're looking at larger premiums, which means larger collateral requirements. So this again is another opportunity that 7702 has provided to Lincoln with the use of our high early cash value riders. So what I'm going to try to do now is show you a design utilizing, first not utilizing our, how do I get rid of this? So this first result is going to be a 60-year-old male. We're looking for 20 million in death benefit. I'm using a 10 pay. We could go less, but if I'm going to reduce the duration of premium, I'm going to look at having to roll out later. So typically, we want to fund these designs, max fund them up front and roll out as soon as possible. So in this case, 60-year-old paying for 10 years or borrowing, paying interest all years and rolling out in year 13. You can see the under the cash surrender value net of loan column where we've got a collateral shortfall. Its highest point being in year 5 at 2.5 million. But what we were able to do is maintain this $20 million death benefit through life expectancy with just a shortfall around age, 92, just slightly below 20 million. So what could we do to help offset some of that collateral if, posting 2.5 million at the bank makes them a little squeamish? We could add a high early cash value rider. This is utilizing our lever, which gives you 3 options. You have the option of 100%, 93%, or 85% of cash surrender values equal to premiums paid for this first 7 years. So now you can see under the cash surrender value net of loan, we have zeros for the first 7 years. This means, to Peter's point, the policy is fully collateralizing the loan for the first 7 years, one of the longest durations in the industry. If any other carrier offers any type of high early cash value rider that gives you 100%, the max is going to be for 3. Lincoln has it for 7. It does grade down after that, years 8, 9, and 10. So the high point here is 400 some thousand, which is, clearly a lot less than that 2.5 that we saw in the previous designs. Same client, male, 60, 10 pay rolling out in year 13. What is the give here if you're utilizing this high early cash value rider? Well, it's going to have a slight drag on policy values. So in the other design we saw, we dipped below that 20 million at age 92. Now we're going slightly below at age 90. With some adjustments, again, we could push repayment back to help bring that death benefit back up if there's concern about not having the 20 million at age 90 or after. But I think, most people are just concerned about getting that 20 million through life expectancy. So, again, higher funding limits, higher collateral needs. Lincoln, again, has the ability to help offset that with our high early cash value riders. A couple other things I think Peter had asked, or I forget who it was earlier, about the net worth and income requirements. We do look at the younger ages, as Mike had alluded to, at a reduced net worth. Instead of 5 million, we'd be looking for 2.5 million, but we would want to see significant income. These are what we call in the industry our Henry clients. They're high earners who are not rich yet. So their income is going to be around, 800,000 or more, and their net worth might not, be at that 5 million. So we're okay with accepting those. So I think, Lincoln's average age has gone down slightly because we do have that very competitive space with that net worth and income for those younger age clients. But we know that with the estate tax changes and the proposals, with our 7702 updated product, we're really excited about being back in the estate planning and wealth transfer space. So, plenty of opportunity with Lincoln. A couple other things I wanted to mention, don't, forget about your term conversions. We do allow those to be financed, and we also allow for foreign nationals to finance in the premium finance space at Lincoln as well. So, I don't know.
Michelle, if you can just bring up one of those two illustrations, and while you're doing that, I'll answer one of the questions in the chat. We are looking at non-New York cases here. In New York, it's a little more difficult with product. It's not impossible to do premium financing, but it certainly doesn't look as good as this. So here's what we typically do when we have a high net worth individual in New York. Is we look at what the Nexus requirements are. Lincoln's pretty liberal. So our Nexus requirements are three part, and it's one or the other. They're not ands. One, the individual lives in New York but works in another state. Two, the individual lives in New York but has a second residence in another state. Three, it's trust owned and one trustee lives in another state. If you can meet one of those three, then you can use that other state's as Nexus and write a policy there. Of course, you need to be licensed both in New York and that other state. But for vast majority of people that we deal with a large policy, typically are going to meet one of those criteria. So then we can look at this product. So just a couple of things. This is actually the ledger that we like to use in explaining the mechanics of the premium finance, but these are net numbers. So if you go to the actual illustration is going to show cash values to be significantly higher. So when we're looking at using this lever writer with the where we have cash surrender value net of loan, that means that the policy has a value of at least the cumulative premium. And for those first 7 years, Lincoln's rider is guaranteeing that the cash surrender value is will be at least equal to the cumulative premium. And as Michelle said earlier, there's no other company that offers that for 7 years. The brackets in year 8, 9, and 10 or 8 and 9 will show that the cash value in those years, when that rider falls off, the guarantee for the first 7 years, that there is a shortfall, and they would have to post collateral of $406,000 in year 8 and $342,000 in year 9, so that to meet the cumulative premium requirement. That means the cash value is $406,000 less than the cumulative loan. And then when we get to year 10 and thereafter, the cash value exceeds the cumulative loan. So there's no more collateral required, no more loan required, assuming that the returns within the policy are what we're illustrating, which is the 5.7%. If the performance is greater, there would be less requirements for collateral. If the performance is less, then it could require more and longer collateral. But again, that's performance risk. Interest rates, we typically assume an interest rate on the loan of, do we have the interest rate here?
I don't know why I didn't vary it, but
Okay, so this is fixed. I mean, normally what we would do is look at the current rate, which is around, I don't know, for this, probably 2.7%, and then increase it by 10 basis points a year, just to show that, interest rates can go up. Now they can go up higher, or they can stay the same, or the client can get better terms than we're illustrating here. So the interest rate risk would be on the what the bank is going to charge. And then the last two columns are, this is the death benefit that the beneficiary would receive after the bank is repaid in the event of a death. And that's important. These are net numbers after the loan gets repaid. The IRR page is the return on the cumulative outlay of loan interest that they need to achieve elsewhere to match this. So we're looking in year 25, so that puts the person at age 85, which is right around life expectancy for that 60-year-old. And we're looking at 9.6% after-tax return. It's hard even for that hedge fund manager to match that. But certainly, this is an example of why premium finance is attractive to people in this. We are looking at a lot of money that they're borrowing, but we can help with the collateral. Now, that rider is only good if you surrender the contract, so that's why it's used as collateral for the loan. It's not available for 1035. It's not available for borrowing. Okay, it's an accounting rider, which allows for the reduction and elimination of collateral requirements other than the policy. Now, the first policy illustration was one without the rider, which is when the client would be posting more personal collateral, would end up getting a more higher performing policy. But so that's the cost that comes with it. This will deliver more death benefit, but during the early years, the first 8, 9, 10 years, there would be collateral requirements that client would have to be able to manage. In this case, it was how many years? 8 years they had to post collateral from anywhere from $800,000 to $2.5 million, and based on that outstanding loan, which is the cumulative loan received from the bank. So that's what we're looking at. There's probably another 70 pages after this that go into the actual policy itself. And the actual policy itself, we're going to show gross numbers, which is going to be, the loan plus the net death benefit, and in the cash value without repaying the bank. So that's all built into the way we design and illustrate and present a premium finance case to you so that you can present it to your client. So this is our Wealth Accumulate 2 product. As Michelle showed you, highly competitive. These are the gross numbers. All right. And of course, we're looking at all current returns on an IUL, and I'm assuming that everybody here knows how an IUL works. So I'm going to open it up for questions further and for any of us, and let's keep it informal and have a little chat about it.
Anybody have any questions? I do want to caution you with some of the premium finance programs that are out there and understanding the banking aspect of the thing. There are a lot of programs out there with banks, and they'll lock in rates for 10 years. But there's a lot of little intricacies, if you don't know what you're doing, that your client may get very frustrated with and very frustrated with you, particularly when it comes to year 2 and 3. Some banks require that you post collateral 90 days before the loan. Now, that adjusts every year depending on the collateral requirements. So you have to be very careful in knowing who you're dealing with and knowing how those banks work and knowing how those bank deals do. I'm just telling you to avoid some of the pitfalls. Now, the relationship banks, let's say you have a good relationship, your client has all their money at Chase Bank. I'm using Chase as an example, as one of the biggest banks, and that's called a relationship bank. And they may be holding, $20 million of assets in that bank. And Chase may say, okay, we'll give you, LIBOR, which is at 30-day LIBOR, it's just 0.33 right now, plus let's say 1%, maybe they'll give you 1.3%, but that's all predicated on they holding that $20 million sitting at the bank. So you may have a much larger collateral requirement or commitment to that banking institution in order to get a great, unbelievable rate. So these are things that you want to run by and know what's going on. And, it's great to make the sale, but if you're not there year 2 or 3, you're headed for a lawsuit. Okay, because all of a sudden your client doesn't understand, he doesn't know. So you want to tread this space very carefully and consult with us and really go through the weeds. And even if you're doing a program, I know there's some structured programs out there that are out there. Some of their little things that they don't tell you that are structuring these programs, whether it's in a group tranche or whether it's in another program. I know Peter's nodding his head that we've discussed. Some of the loan deals that they have, they say, oh, we'll lock in a rate for 10 years, but all of a sudden they have a minimum rate on there that is much higher than the market rate is, and you can't get out of that loan. So I'm in 2 loans right now with a minimum rate of 4%, okay, which is, wow, and I can't get out of it. Bank has locked me in, and I got to post collateral 90 days ahead of time. And, 90 days before the loan's getting ready, oh, we need $180,000 put in the trust account. Well, wait a minute, I'm doing this, I'm doing that. I mean, you're dealing in large numbers, it could be complicated. I just want to caution everybody, it's not just the initial sale, it's a follow-up every year. You want to track the interest rate, you want to track the loan rate. Go ahead, Scott, I'm sorry.
So if I read that correctly and what you said, as well as the illustration on the screen prior to Neil talking, it looked like there was no collateral for the 7 years because of the rider.
Yep.
That's huge compared to some other illustrations.
Absolutely.
And that number that shows up in year 8, 9, and 10, let's say, hypothetically, those are basically adjusted based on inflation and interest rates and everything else, I assume.
Correct.
Right?
Correct.
It's on performance of the policy.
Right.
And the performance of the policy, right?
Yeah, we did one of those last year. Was last year? Yeah, I did one last year with that rider. The compensation was not the same, by the way. It was less and it stretched out much longer. And a lot of these deals are stretched out over 6 years, or, they're different. But that 100% rider for that client was the right thing at that time. As a doctor that, really didn't have any collateral, went through a divorce, and, things were helter-skelter, but needed the coverage. And
Yeah, is that rider making the policy much more expensive than some other policies because of the lack of collateral for those first 7 years?
Well, it does impact the performance. If you compared the 2 that Michelle put up there, the one without the rider performs much better in the long run than the one with the rider. The attractiveness of that rider is where an individual does not want to post collateral for this loan, and that's the difference between them doing it and not doing it. If they're posting collateral for all their other loans and they can put this in there, they're going to have a better performing contract without it. However, one of the objections to premium finance is the posting of collateral on a loan. And Lincoln has a rider that helps to overcome that objection by guaranteeing that if they change their mind, if they can't meet any of the requirements in the future, you can surrender the Lincoln contract and we'll repay that loan for you, as long as you pay the interest every year.
right.
So no one else can do that. And that comes with a cost of performance. It comes from a cost of compensation that's spread over a 6-year period of time as opposed to being paid all up front. But it is, I don't know what the percentages are, but it used to be a high percentage of what we sold in the premium finance market had the rider. Michelle, you know what the current percentage is?
Yes. So, I mean, last year, 64% of our cases sold with a higher cash value rider.
Okay.
So, you know, a lot of times I only show it up front without the rider because a lot of these people with significant high net worth, they don't have an issue posting the collateral. In some forms of collateral, I'd say the most common form of collateral that we see utilized is a letter of credit. You know, the more liquid, the better.
But you have three different early cash riders. That's one
Right.
of them.
So we've got the lever, which is the enhanced values rider that offers either the 100%, 93%, or 85% in cash surrender values equal to premiums paid. And then we also have the SPE, which is, I think, more common across the industry. It's just simply removing the surrender charges. So that gives you roughly 70 to 75% in cash surrender values equal to premiums paid.
So what is the cost of this rider, number one?
So, I mean, basically there is a funding requirement. There is no charge for the rider, but in order to maintain the rider, there is a certain funding requirement.
The cost
So
and
it-
We're
performance.
talking about the 7-year rider with no collateral? Is that the one you're?
Yeah, it's cost and performance.
So if you actually, when we showed the designs, the premium actually was less than the premium without the rider. The premium amount actually went down because we don't want to mech the contract. So there's the funding
Right.
limit, plus there's the mech. So the actual premium amount went down
Okay.
for that rider. But the target stays the same. You're just going to get spread over 6 years for what you get paid. We can look, I can send you one of the designs that shows the policy expense analysis. So there is going to be that funding requirement in there, but you know, it's not coming at an additional, you know, expense really.
I will tell you that if you look at capital intensive manufacturing business, auto dealers, construction companies, hedge funds, they're all very familiar with posting a collateral.
Yeah, sure.
But there are going to be people that you're going to introduce this to that have not had that issue before, or they're involved with other things that it becomes important. So we can address it based on the opportunity that you have in front of you.
Okay.
I have a quick question. So just just to understand, the premium, as per the illustration, is variable on this contract. Yes.
Yes,
Okay. And that there.
it's an IUL contract.
Right.
So it
So
works
it's
like any other
it's
IUL.
going to go
Wait, did
up
you say the
regardless.
premium is variable?
Well,
You can-
yeah, like I mean, in the first year it was showing 180, then it went up to like 320, then it went up to 470.
No,
that was the
those are
interest.
the interest payments.
That was the interest.
Yeah.
That's not the
isn't that what-
premium.
Isn't that what? So what would the premium? If you
The
can help me
premium was like
understand.
it was the $2 million for 10 years is the
Right.
premium to Lincoln.
Right.
Interest payment is the interest payment to the bank.
Right.
But the premium is coming from the bank in a
Right.
loan every year.
So it's what the client's coming out of pocket. So
right
essentially
is
that
the
would be,
interest payment, right?
sure, that would be
Right.
their premium.
And we
Right,
could
so-
we could structure the deal, Natalia, so that it could be a level payment for 10 years,
Okay.
or
Yeah,
it could be interest as borrowed,
Yeah.
which is what they're showing. So if I borrow $2 million at 3%, it's going to be $60,000. Next year I borrow another $2 million, so double that number. Because now I borrowed 4 million.
Yeah.
So
Right.
that's kind of how that's going up.
Yeah, that's my only concern, because when a client asks, oh, well, how much am I paying? Like, you know, and you tell them, oh, well, it's going to be different every year, and it's, you know, that's not going to
No,
fly.
what
so-
you're telling them is if you're paying the interest every year, and in some contracts, you can, if the person's high net worth, you can defer some of that interest, but they're showing you the actual interest
Right.
due, which they would prefer you pay the interest every year.
Right.
But, you know, these designs can be altered to handle your client's needs
Right.
and net worth. And that's really the name of the game. It's not a cookie cutter program.
Mhm.
It's not, you know,
I-
the idea is you want to be in this space so that you can be creative and help your client with whatever their particular needs are. And that's all in the design of the product.
And I
You
think
know,
it's,
Okay, thank you.
if you look at their actual cumulative, payment is just slightly over 6 million. If we looked at life expectancy around age 85, they've paid over 6 million and have a $33 million death benefit. So while the premium, out of pocket cost to the client might be varied, overall, they're paying significantly less for greater benefit.
which is why you do it. One of the reasons,
Right.
multiple
And-
reasons, as we said.
Also,
And
it's also one of the risks you need to explain to the client. The interest can go higher, go lower. As Neil said, you could prepay. So if you wanted to, you can pay down the loan a little bit. So have a premium of $300,000 a year, let's say. So they have a fixed payment of $300,000, but at some point, that interest, the interest is going to be greater than $300,000, so the loan is going to go up, which is going to impact the performance down the road. But rather than going through that now, I think those are the things you work with Neil on, based on the client, and then as I said earlier, we can be flexible in creating a design that would work with Lincoln, and then hopefully would work with your client.
Yeah, I'll say two more things, and one of those will be an answer to Brian's question. So we do allow for some accrual of interest, so some of that interest can be deferred. In those cases, we really want to see that the clients have significant net worth, because they are putting more stress on the policy. They are expecting the policy to achieve more since they're rolling some of that. So we're looking for a minimum of 10 million in net worth, and then we're only going to let them accrue for a max of 10 years. So let's say in that level pay option, if we were utilizing 300,000, we know in year 12, the actual interest payment due was 800,000. So, they've deferred some there. We're only going to allow that for a period of 10 years. And then to answer Brian's question about the lenders, we're open to any, as long as they're in I think it's top 200 US banks. They are US based banks only, but the bank we see most often utilized is Wintrust. I'd say about 50% of our policies have placed utilizing Wintrust as the lender. Yes, and I do have.
Peter, you want to show an accumulation play? Okay.
So I have one quickly. It's the ladders that show where we were. Let's see.
I'd like to see an income play is really what I'd like to say.
Give me 1 second. This is the ladders that we showed earlier, but this one is on a 45-year-old male. Okay, let me share my screen.
Peter, you're talking about finance, right?
Yep. Please.
So this is a 45-year-old male, 10 pay, this, same type of design. We're rolling out in a participating loan in year 15, and then we're taking distributions year 16 through 36. Lincoln's distributions are around 478,000. I think it's interesting here, we're still able to maintain that death benefit around life expectancy of 10 million, where you see all other carriers are significantly less, which is interesting because we're still able to take more out of the policy. And still have a significant target. So they're getting those distributions clearly for about 20 years, 478.
And how much are they paying in that policy? What's the?
Well, the premium is 662, so I'd have to actually pull the illustration. If you give me a second, I'll try to run one so we can look at the numbers.
So they'd be paying the interest on the premium on the financing.
Right.
Right. Every
We'll
year.
try and do a leveraged 100,000 a year for 10 years.
Listen, I've had a lot of success with Lincoln's 401k team. I've had with their annuity team, so I'm ready to jump on board with the premium finance team.
Terrific. Glad to hear that. And we're happy to help you. Well, Michelle's putting that together. I want to remind everybody here what Neil said earlier. Lincoln has a formal table reduction plan. So anybody up to age 70, up to $10 million who buys any of our universal IUL, GUL contracts would have an automatic upgrade for up to a table 3 to a standard. So when we're in this marketplace and we're dealing with people who are more than likely have 1 or 2 health issues, and they're in their 60s and they're doing premium finance, we have that window of standard to a table 3 or C that we can illustrate at a standard, and it's an automatic for us. Again, up to 10 million of Lincoln coverage, and up to age 70. So we need to know if you have any other Lincoln coverage.
Don't forget, it's 60 in the finance.
Sorry.
Up to 60,
What
right?
I gave you is our general rule for premium finance. It's to age 60. Thank you for that correction.
Yes. All right, I think
Now, I just wanted to give you this. I know people got to go. We're out of time. Just want to give you one example of an
Out of
underwriting
bounds,
win.
I'm sorry, bye.
Okay, if you have to say,
Thank
just
you.
one underwriting win that Lincoln did for me probably 2 years ago, just to give you an idea of how great they are on an underwriting basis. We had a gentleman with a PSA score of 10.6, 72-year-old gentleman. Okay, and he was a decline in a couple of carriers, but I asked my agent who came to me, and I said, let me ask you a question. I see his PSA scores all over the place. Does he do any strenuous activity like horseback riding or anything like that? He says, as a matter of fact, he sold horseback riding equipment. And unfortunately, he's not on the call. He was scheduled to be here, and he could justify this. Well, I said, very interesting. So he goes horseback riding 3 times a week. So with a 10.6 PSA, age 72, Lincoln took the initiative, the only insurance company that took the initiative to run a free PSA test and said, you know what, Neil, you're right. They gave him preferred non-smoker for $3 million. Okay. We got a case that nobody else could get because of Lincoln's underwriting. I have another case with an attorney who's very close to me, who met me on the train, and he's talking about how he applied for $3 million of coverage, a young gentleman, and he had a mild heart thing. He said, this guy works out MMA. He says, I was quoted $300 a month for my policy. I'm paying $700 a month. I took it out 3 months ago. The other agent or agency shopped the entire market, and the best they came up with was a D. He says, I don't have anything wrong with me. We went to his doctor. His doctor gave us a write-up. Lincoln gave him best class. Best class, after it was already shopped from a larger agency out of New Jersey. Well, a very big agency. But we positioned it to Lincoln the way it should be positioned, with our underwriting and their underwriting cooperation, and we got best class. That's called great communication, great understanding of the numbers, and just terrific performance where we can outperform the market by doing the right thing for the client. And that's what we do for all our agents. And that's the Main Street Planning Group difference. So thank you for coming today. If anybody wants to reach out to me, you can reach out to me. I have this thing recorded. We'll send you out a recording of this. If you have any questions, please feel free to reach out to us. And thank you all for your participation. Have a terrific day. I know it's we're running a little over time. Thanks,
Thank
Michelle.
you.
Thanks, Mike.
Yep.
Great
Bye.
job.
Thank you
Appreciate
for all
it.
being here.